Stocks fell for a third day in a row today, so I'm going to break down this losing streak to see is it been big enough to cause some concerns or raise some warnings? Is it normal? Is it not normal enough? Do we need more pullback before we feel really good about the opportunity for a bounce off a higher low? So I'm going to break it down. I'm going to break down the technicals that some of these supporting technicals, as well as different intermarket relationships, sector rotation moves, to really gauge how bearish this sell-off, this near-term sell-off has been, and see what we can do about it, and then find that pocket of strength where we can look for an opportunity with today's trade idea. So let's go ahead and get started. Today is Wednesday, March the 14th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that found us that are watching for the first time. Glad to have you. Keep coming back for more. Subscribe to our YouTube channel by clicking that red subscribe button right down below the video there. You can do that right now while you're watching. Also, while you're down there, hit that thumbs up icon. That lets me know that you got something out of it today, number one. And number two, it lets me know that you want me to do it again tomorrow. So it's a quick, really easy way to let me know what you're thinking. Comment on anything that stands out to you or any questions you have from today's video. You have to scroll down further down below to see the comment section. And then finally, join our daily email list. I send out an email every day, Brandon and I both, with a summary of what we talk about in these videos, as well as a list of all the overbought and oversold clusters on the market forecast indicator for stocks in the S&P 500. So to get that, join the email list. I've highlighted the link in the description to do that. Follow me on Twitter for more content. There's a few things I've been putting out there yesterday and today. Make sure you're getting that content. Follow me there. You see my handle on the screen at DavidSettle42. There's also a link down in the description that will take you there. Like and retweet tonight's Market Outlook tweet. Keep doing that. Make sure you're doing that on a day-to-day basis there. That, again, another way to let me know you want me to do this again tomorrow. And then finally, join our community, our Market Outlook community on Facebook. The address up there again at the top, link down in the description I've highlighted. There's about 950 of us now. So join us there to keep that conversation going with other people that are watching these videos daily like you. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. You can see that we have pulled back now. We've continued to pull back. A little bit of an evening star candlestick pattern here at the top, right at that line, which now is actually acting as a resistance level. I mean, this is a completely arbitrary line. It's a line 23% return for the calendar year based on the average return for any calendar year where the S&P is up more than 5% in January. So that's the average return. So again, completely arbitrary, but happens to be acting as a resistance right now. But you notice we're not that far away from the pace of a 23% return for the calendar year, despite all the volatility that we've been hearing about. So again, perspective, right? But you see, so we're pulling back, and the near-term line's pulled down. The near-term line actually is dipping its toe a little bit in the oversold area. The momentum line is also down, but again, but not at extreme lows. So technically, this combination here is a bullish intermediate confirmation signal. It's 2 days in a row now where you have an oversold momentum line that's not too far oversold, right? When it gets to extremes, which to the downside an extreme is below the 5th percentile, to the upside an extreme is above the 90th percentile. Because fear is a stronger emotion, right, than greed is. So that's why we have that distinction there. So we're not an extreme down here, this bullish signal is improved when the near-term line's also below 50. So you notice yesterday, if I were to kind of bring this back a few days to here, bring this to yesterday, this signal that we got yesterday too is improved when the near-term line is also below the 50th percentile. So it's in the lower half of this chart, ready to bounce up off of what would be a bullish near-term low point. Okay, so now the other side of that coin, the signal is diminished a little bit in terms of reliability when the intermediate line's not up above 80, when it's not this kind of nice strong signal here, strong trend. We don't have that yet either. So, so yesterday we were missing a couple of things. Today we still don't have the intermediate line above 80, but we did bring the near-term line below 50. Now, we don't like it to get in the reversal zone at all, really. But in this case, it's really only, you can tell here, it's only really dipping its toe in there. And you notice too that this would be, in fact, we kind of have to change this now to because now we're currently forming a low point. The near-term line's below 50. I draw these ovals when we form near-term highs and lows. Anytime the near-term peaks above 50, you get a red circle. Anytime it bottoms out below 50, you get a green circle. Just to kind of see the trends and what we're doing here. So you can see now that this current low point, if this indeed ends up being the low point, a bullish near-term low, not as bullish because of that slight toe dip down there, but if this ends up being a low point, that's a 38% retracement of the previous bullish near-term run. That didn't quite get up to new all-time high or new highs on the S&P. Now, of course, it did on the other indexes. We'll see in a second, but it didn't on the S&P 500. But look at that. I mean, that is a normal pullback, as doom and gloom, and that's kind of what I was pointing out today on Twitter. For those of you who follow me on Twitter here, there's a few things I pointed out today. For all the doom and gloom that you hear about, and this seems like, look at that decline. You just look at that, and this seems, well, even if you don't listen to pundits, right? If you just look at the chart and you think, man, this is really negative, but that just again shows that fear is a deeper emotion than greed is, because look at that rally. That wasn't anything earth-shattering, but that pullback is, right? Not necessarily earth-shattering, but fear-inducing, right? And again, that much of a pullback is more fearful than how bullish, how happy, or how much this kind of a bullish run makes us really get after it, so to speak, from an emotional standpoint. So there's a few other things I brought up. We'll talk about more here in a second, but that was one of the things I tweeted out there today, and that's what we're getting. So, a 38%, that's about as normal and pretty darn bullish of a pullback as we can get. Because remember, if it's less than that, then it's, the little pullbacks, those little, like inhaling and exhaling, a little exhale. If you get big inhales and little exhales, eventually you just run out of air and you get that, right? We've talked about that before. Same thing with that, big inhale, little exhale, another inhale, and blah, out of air, because we were already almost at, had a good run of being out of air there. We're just now trying to get our breath again. Well, now again, another inhale. This is a normal exhale. This right here doesn't have to be 100% retracement. Just 38 to 50% retracement is a normal exhale on any kind of trending run. So that's what we got, and it's not a bad thing. In fact, it's very, very, very normal thing to see. Now, of course, the Dow Jones had twice the pullback that the S&P did on a percentage basis because of the influence of Boeing. So it's a little bit more of a pullback on its near-term rally. So there's the previous near-term rally, which was not as big, because remember the S&P got a little bit above those highs. The Dow did not. And so you can see a little bit more of a pullback, a little bit past that 50% Fibonacci, but still within that kind of middle zone there that we look for a normal pullback in. A little bit deeper of a drop on that near-term line too, but still would be a higher low point. So what we're seeing here on the Dow is, again, because of its influence of Boeing, which pushed Dow up more than the S&P for so long, now we're seeing the negative impact of that influence there from one stock. The NASDAQ composite, which has been just killing it, you can see here its near-term line also dipping its pinky toe in the water there. You can see from it's a little bit of a bearish engulfing pattern above 70, pulling back to 7,500. We talked about that on Monday. Looking for that pullback on a near-term basis. You can see that actually happens to be right where the 23% Fibonacci retracement is for this pullback. So you can see it can still pull back a little bit more and still be normal, even though here again you have a better intermediate confirmation signal, the oversold momentum line with a strong posture, and then now the near-term line being below 50, and just like I said, dipping half of its pinky toe into the lower reversal zone. And then finally the Russell 2000, same thing. I mean, it's not even getting close to the 23% Fibonacci retracement level. I mean, look at that. It's, if I bring that up here, oh, we're right on it. We just happen to be right on. And again, that's not enough, right? The 23%, you know, that usually 38% is the normal exhale. So, you know, that's just a little bit of a pullback. 38% actually would happen to get you right back to this old high. Could use it for a support bounce and then move higher. Again, same thing. Its momentum line actually is below the 5th percentile, so it's a little too low for what we'd like to see, but that near-term line is still holding up. So the situation here, we say, okay, we don't want it to go any deeper. Even though it'd be nice and normal, we don't want it to go any deeper. We've seen it already pull back more in some of these other indexes, and that might be enough for this too, because we get deeper than this, and now we'll start to get a really bearish short-term sentiment that could signal a forthcoming change in the intermediate posture. Interesting too to see this pullback that we're getting. You notice pulling back down to this 2750 area, a little bit below, but right at that 2750 area, still above the 50-day moving average, still above the 200-day moving average. Both are rising. Now the gap is falling a little bit as the 200-day moving average has got a lot more room to catch up, so rising a little bit faster. But you know, nothing that we haven't seen or expect in terms of some volatility around that 50-day moving average as it flattens out and the 200-day catches up, and the gap, which is still very, very large, larger than any other time on an absolute basis that we've seen, as much as it's pulled back. You know, still, you know, there's still a lot of time, and that gap typically grinds down with some ups and downs as we move towards lower levels that would precede any kind of significant move to the downside, where we stay below that 200-day moving average. Look at the 3 green arrow chart. You can see we're still above let's get rid of that Fibonacci line now again. We're still up above the 30-day moving average. The 8 and the 17 are also still up above that. We're testing the 8-day with today's pullback. So that kind of shows this 2-day pullback is, again, as deep as it's been. 3-day, really, if you count that one right here. As deep as this 3-day pullback has been, it's brought us down to the 8-day moving average. And, you know, we'll move along the 8-day moving average before testing the 17-day, while both of these are up above the 30. Now, the 30 is not rising yet, so we'll see if, you know, if this little bounce can hold here. But the MACD is up above 0, it's up above its moving average. Stochastics is also up above 50, up above its moving average. The gap between the two is slowing. That's why the histogram is dropping, but it hasn't crossed over yet. So yeah, there's been some short-term weakness, needless to say, over the last couple of days, but nothing on a short-term basis that would suggest that the intermediate trend is changing yet. And so again, you don't expect it to. You don't expect the trend to change until you start seeing the signs of that change. And near-term weakness is not, you know, a sign of a change. It's a sign of normal trends, higher highs and higher low points. So you're going to get low points during trends. That's the nature of trends, of bullish trends. So nothing yet that would suggest that trend is going to change, other than just a normal opportunity for a higher low point to develop and we'll bounce. Now, if we don't, then we'll change up and the posture and see what to do from there. But until it doesn't, until things change, our expectations are, support will hold until it doesn't, right? We talked about that all the time. And trends will maintain themselves until they don't, right? And so we follow the trend until things change. And again, short-term weakness that produce normal Fibonacci retracement and potential for higher lows is not a sign that trends will change, right? That's actually a sign that trends exist because of the appearance of higher highs and higher lows. Now let's take a look at the intraday charts, and you can see lower high and a lower low point. We did get a higher high and a lower low yesterday and finished really close to the low point. We gapped up, got the higher high point, which happened to be at the old lows from the day before at 278, and then came down, and then we were holding the old lows until we busted through and then tested that 276 area for a new resistance level before holding at 275. Now look, you can see here's your Fibonacci retracements. And remember, here's the 4-week range. As bearish as yesterday was, we did get a new 4-week high point yesterday. So that's how close we are to the 4-week high. That was something I tweeted out yesterday too. But now the 4-week low point is almost that low point right there. We're just one day. Tomorrow it will be. You can see today we moved it up to that low, but you see tomorrow it's going to be at 265. That low point right there. When it does, that's about a 15-point range. So if you add 7.5 points to find the halfway mark, looky there. It happens to be right about, a little bit above, because we're a little bit above 280 there, a little bit above 272.5. So you notice the 50% retracement of this near-term rally, also because it has a 4-week low and the 4-week high, also happens to be the 50% retracement of the 4-week, or 50% level of the 4-week range, of the whole range. So again, as long as we're trading in this end of the range, everything is fine from a bullish standpoint. Once you get into here, it doesn't mean you're strongly bearish. It just means that you're not bullish anymore either. When you're in that bearish zone. But typically you don't break out and start pushing below the lower end of things until this range, which is still very wide, not as wide as it has been, but it's still a very wide range. Usually that range will tighten up before you start pushing the lower bounds of the range and trending lower. Now, it doesn't mean that can't happen, because anything can happen in technical analysis. The odds are lower for that to happen, though. And so we have to go with what we've seen in the past, which is, they continue to bounce off higher lows and push up against this high, bring the higher low up until we start bringing up the higher low a lot faster than we're pushing up on the higher high, and the range tightens up. The 4-week range tightens up, and we start trading in the lower half of it. And then now we're not bullish anymore. We start threatening the lower bound, and the trends change. That's the expectation. Those are the kinds of things we start to see when you expect a trend change. And of course, as you can see right here, not quite seeing it yet. From a long-term perspective, you can see, let's get back to this chart really quick and see the volume for today. At just a smidgen over what we were yesterday, but again, right at an average volume, which happens to be a much lower average than what we've seen, about 100 million. So again, put that in context here. 100 million shares is still, a little bit below average, and a lower end of the 52-week range that it's in. And then today's trading range at 3 1/3 points is still relatively high, and not what we'd like to see for too long, but still below the average. So as long as these lines are dropping, that's okay. It's when we start seeing those numbers for volume and trading ranges, when these lines are really low, that's when you start to really worry about bearish moves. And of course, we're getting these numbers with these lines being higher, so they're on their way down. When they're on their way down, that typically coincides with kind of a more intermediate bullish trend. Volatility, you can see it's rallied. I have to duplicate this now because now that low point has developed. So again, creating these ovals when lows and highs are formed using both oscillators here. So anytime the MACD and the stochastics peak above their midpoints, I put a green oval. Anytime they develop below their midpoints together, then I form the red oval. And look at how you can see at 17 1/4 volatility is still much lower than the last peak, and even the peaks before that. At 20, up above 20, both of them, you can see the low points when we had this after coming down from 40. The low points are right about 17 1/2. So that's about right now where we're hitting some resistance so far on volatility. And from on a relative basis, you can see that volatility ramping up the last few days. Now in the lower end of the neutral range, 90 to 95% is not bearish, it's neutral. And the fact that we're just barely inside the lower end means, again, This is not that bearish of a move right now. It's typical short-term weakness that you would expect when you're forming higher highs and higher lows. Now let's talk about what's driving this price action. As we move into that, I did want to remind you we have been getting fewer engagements here on our Market Outlook tweets. I just want to remind you that the more you engage with my tweets, the more Twitter will push you all of my tweets. So that's a way for you to let them know that you want to see all my stuff, because they have algorithms. Depending upon how many people you follow, you might not see everything from everybody you follow, simply because of Twitter's algorithms there. So that's a way to let them know. It's a way to let me know that you want me to keep doing these videos. And finally, I get the benefit out of it. Because then the more engagements this has, the more they'll push it out to all my followers to make sure that everybody's seeing this because of the numbers that they're seeing here. So we're kind of dipped back down below 100 over the last so many tweets. Let's see if we can't get that back up above 100. See if we can't reach that magical 150 number. That's our target that we haven't ever got to. Close. 142 I think is our maximum. So we'll see if we can't hit that record high here. All right. So I've been tweeting out a few things today, so make sure you're checking some of the stuff out here. I'll get into some of these things, but the main topics today was the GDP estimates coming down, and they came down today because, and you can see it right here, coming down below 2%. They came down today because retail sales showed a third consecutive negative month. We haven't seen that in a while. Since the beginning of 2015. That's the third one right there, actually. You don't see the other two at the beginning. You actually do see it on my tweet right here. So those are the three. So a lot of chatter about 3 consecutive negative months. You can see the annual growth rate that was rising. So, we didn't hear about that. We just heard about 3 negative months today. The other thing too that impacted, you can see business inventories came out. A little bit higher. You can see inventories rising up, and the inventories to sales ratio rising up a little bit. That's not the best thing for the economy there. But 1 month, right, doesn't make a trend so far. And then finally, the PPI came out. This is the month-over-month change, year-over-year. So what's more important? You can see inflation still rising at the core level too, 2.5%. Typically is higher on the wholesale level than on the retail level. We'll see that with CPI here. And, we have CPI coming. Eventually will become, or CPI came up on Tuesday. Over here, and it was rising too, not quite the 2%, right? So. That came out. That number, inflation's rising, but not rising to the point where that's impacting interest rate hike expectations. You can see interest rate hike expectations are still high for March. We're still most likely going to get a rate hike this month at the meeting. But what you notice are the odds of another one by June are dropping. They're still high, still 70%, but not as high as they've been. You can see they were 75% yesterday. So dropping down just a little bit, but dropping today despite the rise in inflation on both the CPI and PPI level. But a lot of it coming from here. The GDP estimates are falling. And again, that was something else. See, on my tweet here, I pointed out that the 3 months in a row on the retail sales, what didn't get talked about was the fact that we're coming off of probably the strongest 3-month period we've had in multiple years there, right? So of course we're going to have a little bit of a pullback after such a strong month, 3-month growth period. And then the other one is, we're not even close to losing what we lost there. That got brought up a lot, but it didn't get brought up that we didn't come close to losing that much. So, and as you saw, the yearly growth rate is actually rising despite the 3-month negative months. So grain of salt, right? Tremendous grain of salt. Another thing too about these GDP estimates is look at the previous Q1s over the past so many years. 1.25% last year, 0.5% in 2016. Then that started negative before the revisions. 3.25%, but that was led by 2 very strong growth rates here in normally very temporary areas. So, that's not what you want to build your economic growth on. It's inventory growth, strong inventory growth, and big imports declines. And then finally Q1, where we actually did have a 1% decline in economic growth. in 2014. So, those numbers coming from here, and you can even see from the 1.24% here, that, was also helped by a reduction in imports, bringing that down. You can also see too, because that again, lower imports helps the GDP number, because that means we are building more, and you can see a lot of exports here. That's helping. That's not typical to have less imports than exports growth. Small import loss and export growth, and so that's why one of the reasons why the number was so high for last quarter. Again, very temporary figure, but I mean this is a normal, like 1.9%. It's actually a pretty high number relative to what we've seen in previous Q1s, barring some very temporary factors. Right, so keep that in mind when you're thinking about, man, this is really down from 5%. Well, yeah, of course, it comes down every quarter. This number comes down, that line here comes down every single quarter. It always starts out very high. It always spends, and usually doesn't finish at the low. Lately, it's been coming up off of its low. So, and from an economic surprise standpoint, right here, we still have pretty decent economic surprises here. Yeah, today's numbers were a little to the downside, but still from a 3-month rolling period, which is what this looks at, we're still doing much better compared to overseas. So now let's see how that's impacting different asset classes. We're looking at just what's happening here today, right here. And you can see long-term bonds rallied. Safe haven, and they started out the day pretty positive, but they really took off when stocks dropped here in the middle of the day. So you can see from that point right there, you can see crude oil also dropped, coming down. Small cap stocks pulling back too, but large cap stocks pulling back the most, which is actually a pretty decent sign. As long as small caps keep outperforming, that's a positive for the market. So you can see high yield pull back too, relative to treasuries, but not much of a loss, and a very small loss relatively speaking. And you can see by the end of the day, crude oil rallied. So crude oil outpaced gold, which is a risk-on relationship. So again, not the most risk-off. And when I look at just the 3-month period here, in fact, if we just go from the close here, so this is the full 3-day loss that we're looking at. I mean, large caps are down 1.25%. You can see a lot of it driven by a drop in crude oil. Bonds rallying almost 2%. So that 10-year note yield also pulling back with stocks. And remember, that's been the biggest factor here lately to any weakness is this really high 10-year bond. And we talked about the fact that this could start to grind lower throughout most of this year, as we've seen previously. And that was one of the things, that was one of the headwinds for stocks early in February. The fact that we got up here so far so fast, well, that's going to start to take away that potential headwind if we continue just to kind of up and down, but grind lower towards Fibonacci retracement levels and old low, this 2.6% area over the course of the next so many months. Of course, you can see gold, another safe haven, doing well too, and those are the only two asset classes that performed well over the last 2 months. And again, from the actual high point of the last 3 days, gold, the dollar, and long-term bonds are your outperformers. And you can see down here, again, large cap stocks outpacing small caps to the downside, and even crude oil not being the worst performer. So all positive signs. When you're looking for positive signs in a pullback, typically you see riskier asset classes, emerging markets, crude oil, and small cap stocks, kind of the more volatile asset classes. They should have bigger losses, and they don't. So again, not a bad sign for stocks to see that large cap stocks happen to be the ones with the biggest decline. Of course, what's been leading the highest has been that technology area. It's pulled down here during this 2%. You can see materials, industrials also lagging behind. That was something I tweeted out today too. Again, the article was the fact that when you see NASDAQ strength, that's when you start to worry about the market kind of in the last stages of its bullish run from a long-term standpoint. Well, the reality is it's typically commodities that push up to extreme highs at the end of a bullish run. So when commodities, energy stocks and material stocks, when they show a sustained level of outperformance, then we know we're in the late stages of that economic cycle. That's one of the main tenets of intermarket relationship and sector rotation, is that materials and energy typically outperform at the late stages of a cycle. Of course, nothing is ever 100%, but again, you just have to go off of what we've seen in the past, and that's a typical relationship. Commodities and crude oil typically run higher right before the stock market itself peaks, right as it peaks. So, and of course, we're not seeing that quite yet. We've seen technology and financials lately, but technology more running, doing so well. And again, that's, they're pulling back here. In fact, materials pulling back the most during this run. And you can see utilities and real estate; those have been our biggest losers, right? For months, those have been the biggest losers. They have the most to gain, and they're starting to outperform a little bit. They've been down over the last 6 months, more than 5%, where the market's been up over 10. So big underperformance in these areas, and they're starting to show some rotation. You can see discretionary and technology, your biggest winners over the past 6 months leading up there. And so get back to that 10-day chart here. There's some opportunity there in these areas. Healthcare also outperforming. Consumer staples somewhat outperforming. Consumer stocks both still dropping, but outperforming the broad market during this pullback. And if I just look at just today, utilities were actually up today, 1%. Technology stocks actually were up, previously up too, as well as consumer discretionary. So a lot of these big name kind of FANG stocks were actually up. Not all of them. You can see there's a small loss by the end of the day, but they were actually up here. So again, not what you would expect if we were in this broad-based risk sell-off right now. If I were to go back to here, let's go back a few months to the big time sell-off that we had over here. If I were to say, okay, let's take a look at what's dropping. See, everything fell. Technology, discretionary, everything was falling at 10%. So again, another sign that this is kind of a normal exit. There's nothing in this pullback over the past 3 days that would suggest anything more yet. That we're just forming a new bullish near-term low point that we can bounce off of and expect new near-term highs. Now, it doesn't mean we'll get it, because we don't always get what we expect, because anything can happen. But based off what the charts are showing, right now this has been a normal pullback this past few days. More normal than what we've been seeing when these pullbacks have been so shallow that we end up running out of air, and we end up with these kind of pullbacks here. So for our trade idea of the day, since we did Tesla last time, and I updated Tesla here on Twitter as well, pulling back towards some bad news today. It got close to that low point. So if you're putting your stop order, say an ATR below that low point, you're looking at a stop order about 310. We're going to be right about in this area. So we're close to that low point, not quite close to a stop order. Definitely something to monitor, because that was a long equity trade that we were looking at a couple days ago on that. But now, just because I love those T's, those stock symbols that start with the letter T and that are 4 symbols long, will kind of stay in that area. No, that's purely coincidental. It happens to be a stock in the news today, and this stock has been it's up over 100%. In the year, the past 52 weeks. So it's been doing very well, blowing out its earnings, coming down now, pushing up through the highs, and kind of breaking out a little bit today. I mean, I know we're bouncing up today, and we had 1 red arrow, so we're getting potentially a new set of 3 green arrows here pretty soon. But it's that breakout and hold up above that 35 high point. That kind of stands out to me, as well as the fact that the Bollinger Band bandwidth had really pulled down as we slowed down. We had broken out well above the band, held 35 here for a while, and then today kind of breaking out above the upper Bollinger Band too. So again, we're already pretty high, so I don't want to like say, okay, let's just back up the truck and ride this trend as long as it lasts, kind of a thing. We still want to kind of be a little cautious with and manage risk on the type of trade we want to do and look for some probability. It's got some relatively high premiums. So if I look at selling a put option, below these low points here, the low points being right about $34. So if I sell at those low points, looking into those to hold for resistance, remember 35 is a key level too, because that's the resistance that we had that we were kind of fiddling with and now broken out above. So if we were to sell that 34, which is a little bit below delta, but you notice because of the higher premiums, we're still getting, you know, that 47 cents, which is 30% return on risk. Buy the 32 put in case things really go south on us. Then you notice there's a pretty decent odds of success of getting that, and you can see where the stop order is. So if we hold this 35 area, if we hold, you know, kind of as a primary support, and then, you know, you can see the exponential moving average in between. It's going to act as another layer of support, as well as these low points of these candles. You know, those are all signs and things to watch for to say, okay, if we were to get below all of that and get to that 33 area, then you can see I'll take a loss, you know, similar to the gains I'm trying to get out of it and keep that loss. And a great study I saw actually from Tasty Trade about the benefits of managing the losses. They don't necessarily improve your P&L or your percent winners and losers, but what they do, in fact, the difference between whether or not you just let it go to expiration, potentially take the max loss, or you cut the loss. The difference between your P&L is very marginal. The difference between your percentage winners and losers is also very marginal. The biggest difference is your biggest losses are a lot smaller, and the standard deviation of your portfolio, so the ups and downs of your account balance, that standard deviation is also a lot smaller. So from a psychological standpoint, which is something we always brought up, you know, it's hard to recover from maximum losses from a psychological standpoint, because, you know, in this case, it would take 3 maximum gains in a row to offset that loss, and the odds of that are really low. So now it takes more than 3 trades, because you're going to have some losses mixed in there, and from a psychological standpoint, it just kills you. And you start doing things differently. You start going for bigger winners because you had such a big loss, and you just blow up your trading plans and everything, your rules. So to avoid the psychological drama of that maximum loss, we manage the losses. Not because it improves the P&L or your winning percentages, but because it helps you avoid the big mess that you get that ultimately for most people just starts to get them deviating from what they normally do and from their normal plans, and eventually, from what I've experienced and from years of talking to people one-on-one, it really kind of blows up accounts to where you don't do it anymore. You take a break, you don't do it anymore, and that's what we want to avoid. We want to stay in the game, right? And that managing losses helps you mentally and emotionally stay in the game. I coach a youth basketball team. And that I'm teaching them how to compete. I'm teaching a lot of the kids how to compete. A couple of them comes naturally, but for most of them, I'm teaching them, you know, what it means to compete and how you come back from setbacks and mistakes. And a lot of kids, it's, you know, when they make a mistake, a big mistake, a turnover at least, a fast, whatever it is, mentally they just curl up in a ball, so to speak. On the court, and they get more passive, and when they get more passive, everything goes downhill to where you have to take them out of the game. And so when bad things happen, if you can minimize the mistakes, minimize the impacts of mistakes, then and just keep going, keep playing, next possession, and keep trying to do good things, then you can stay in the game mentally. And again, that's what we're trying to do, is avoid the big mistakes. In this case, it would be a mistake to take a maximum loss, because mentally we just check out. We get a lot more passive. We start changing rules, so we get way too aggressive, and which leads to even bigger mistakes, and we get out of the game. So with that said, sorry about that. Thanks again for watching tonight. I appreciate all those that watch. We're in a bullish posture right now. It's not as bullish yet. It is on tech stocks, so that's why we're kind of looking at some of these tech stocks for some opportunities, the Nasdaq type stocks here lately. But we're still in a bullish posture. We've had some short-term weakness, but not enough to suggest anything different than this is just a pullback for a potential higher near-term low point, bullish near-term low point that could launch us to a new near-term high. Not extreme bull, right? We're not talking about craziness here, but just kind of normal ups and downs. So again, thank you. Have a great evening, everybody. Brandon will be gone here the rest of this week, so I'll be back on tomorrow on his normal slot on Thursday, and then finish out the week with you on Friday. So have a great one. Don't forget to fill out your brackets, and for your NCAA tournament brackets, for those of you who get into that, we'll see you all tomorrow.